I may not need much introduction, but I don't go anywhere at the moment without advertising my newly published book, The Long and the Short of It, Finance and Investment for Normally Intelligent People Who Are Not in the Industry. And since there are more and more not intelligent people around this area who are not in the industry anymore, I hope the market for it will go on increasing. I've spent quite a lot of my life looking at the regulation of industries other than financial services. And what I want to do this morning is to start by spelling out some lessons of regulatory history. The first lesson, and the central lesson, is that regulation works well when it's focused on a limited number of well-defined objectives. And regulation works badly when it seeks to engage in the general supervision of activities to ensure the adoption of what are considered industry-wide good business practices. The latter kind of generalized supervisory regulation tends to be extensive, intrusive, prone to regulatory capture of the kind that has already been discussed, and taken as a whole, ineffective. And today, financial services is the paradigm case of regulation that has that character, generalized supervision, and achieves all these outcomes of being intrusive, extensive, ineffective, and prone to capture. The textbook example in all books on the history of regulation is the US airline industry. It's obvious that we need to regulate airlines because we can't have unsafe planes flying over the City of London. So we need to regulate airline safety. And regulation of airline safety was introduced from the beginning of the industry. But it was apparent to people that if we were going to have safe aircraft, these safe aircraft needed to be maintained by well-run, well-financed companies. So the regulators started looking at the capitalization and finances of these businesses, and they started looking at their business plans. Eventually, regulation in the airline industry extended to the regulation of routes and fares, and by the 1970s, the scope of regulation embraced not just these matters, it was concerned with the distance between seats, and even in one notorious instance, with what was and what was not appropriate content for an airline sandwich. In the 1970s, all that regulation in the United States was dismantled. It was dismantled by a coalition of the left and the right, a curious mixture in US Congress, people on the left who thought that this regulatory structure had become a racket for large corporations, and they were absolutely right, and people on the right who thought that market forces were almost always to be preferred to regulatory structures, and they were right too. And the result of that deregulation, as we all know, is that today we have regulation which focuses on safety. We do have safe planes. We have a competitive market for airline services. And the kind of services that have been offered to consumers have been transformed for the better in the last 30 years. And that approach of focusing on specific public policy objectives and confining regulation to that is what was adopted in aviation. It's something that was followed in other industries like telecommunications, more recently in electricity and gas. That is the regulatory model, and that is the regulatory model that needs to be applied to financial services. We do not, contrary to almost everyone who has talked this morning, need more regulation. We do need better regulation. Of course we need better regulation, but the better regulation we need is regulation which is narrowly focused on important public policy objectives, and the rest of the regulatory apparatus should be dismantled and taken away as fast as possible. Let me draw some specific lessons out of that. What are the public policy objectives we have in all of this? The principal public policy objective is to protect the integrity of the payment system, the mechanism by which we all receive our salaries and pay our bills, and it is to protect depositors, the deposits of retail customers, both personal customers and small businesses. That's the primary purpose of banking regulation. More generally, there's a need for regulation to ensure better outcomes for retail customers. We need consumer protection legislation, and I don't know I know hardly anyone who thinks that the retail financial services industry today is delivering them a good deal. We need regulation which is focused on these particular objectives of consumer protection and of protecting the integrity of the payment system. And most of the other financial services regulation we have should be left to the market and to people to construct appropriate self-governing regulatory institutions without state involvement in order to do them. In particular, we should therefore be regulating wholesale markets as little as possible. We should under no circumstances take the view that the government should act as unpaid insurer of counterparty risk for off-exchange transactions, which is the role which is now being cast for government in describing a whole variety of things as in wholesale markets as involving systemic risk. Either people do these things through exchanges and police themselves, and the exchange polices them, or they make transactions with counterparties knowing they have to do their own due diligence in relation to the counterparty. And in relation to being told that institutions are too big and too complex to fail, well, as Willem is getting to, the only possible public policy response to that is to say if institutions really are too big and complex to fail, we have to restructure them as institutions that are simple enough and small enough to be allowed to fail. Anything else contradicts the whole concept of a market economy in the first place. I've used, and it's become quite a successful metaphor, the metaphor of the utility and the casino. What we have had over the last 2 decades is a casino attached to a utility. And there are two things we can do about it. We can regulate the casino to such a degree that no one will ever lose enough money in the casino to do any damage to the utility. And if you believe that's a feasible outcome, you don't know anything at all about casinos or the kind of people who go into them. Or we can separate the utility from the casino, and that is what we should do.